How to trade with negative gamma. Are you curious about how to navigate the tricky waters of negative gamma in options trading? Let's break it down in a way that makes sense. Gamma is one of the options Greeks, and it measures how much an option's delta changes with each 1-point move in the underlying stock price. When we talk about negative gamma, we are discussing a situation where your delta becomes more sensitive to price changes, which can increase risk. If you are short options, meaning you have sold more options contracts than you have bought, you are likely dealing with negative gamma. This can happen with both call options and put options. For instance, if you sell a call option, your position takes on negative gamma. As the stock price rises, your delta becomes more negative, which means your exposure to the underlying stock increases. This effect is even more pronounced as the option approaches expiration, or the stock price nears the strike price. Now, trading with negative gamma can be profitable if the stock price remains stable or moves in your favor. You can collect premium from selling options and benefit from positive theta, which is the decrease in the option's value over time. However, be cautious. If the stock price moves sharply against your position, your losses can escalate quickly. This is due to the rapid change in your delta exposure, making it more challenging to hedge or adjust your position. To trade effectively with negative gamma, consider these key points. First, position sizing is essential. Start with smaller positions, especially if you are new to negative gamma strategies. Large moves in the underlying stock can lead to significant losses. Next, monitoring your position is crucial. Keep a close eye on it, particularly as expiration approaches or if the stock price gets near your strike price. Gamma is highest at the money options and increases as expiration nears. Risk management is another important aspect. Use stop-loss orders or set limits on how much you are willing to lose. While negative gamma strategies can be profitable over time, a single adverse move can wipe out many previous gains. If your negative gamma exposure becomes too high, consider making adjustments. You can close part of your position, roll your options to a different strike or expiration, or hedge with the underlying stock or other options. Hedging is a smart move. You can offset negative gamma exposure by buying options or shares of the underlying stock. For example, if you are short calls and the stock price rises, buying shares can help neutralize your delta. Negative gamma strategies are often used by traders looking to collect option premium and profit from time decay. However, these strategies requiring careful management and a readiness to adjust positions as market conditions change. Always be prepared for the possibility of rapid losses if the market moves sharply against you. Understanding how your exposure changes with the underlying stock, managing risk through position sizing and hedging, and being ready to adjust your strategy are all part of trading with negative gamma. It can be a rewarding approach, but it demands discipline and active management to navigate the risks involved.